Do you know that for multinational businesses, a single misstep in transfer pricing can cost the business millions in tax liabilities? That is why it's crucial for every business involved in multinational business operation or small businesses expanding their operations internationally to understand how transfer pricing audits work. This is because transfer pricing audits ensures that related party transactions comply with the arm's length principle, thereby safeguarding the company's financial health. In this video, we will break down the transfer pricing audit process, explore the role of the Federal Inland Revenue Service (FIRS). So buckle up and join us on this journey. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Transfer pricing audit primarily involves reviewing transfer pricing returns and supporting documentation submitted by taxpayers engaged in related party transactions. This process enables tax authorities such as the Federal Inland Revenue Service (FIRS) to independently confirm the arm's length nature of the related party transactions as documented in the transfer pricing reports and make appropriate adjustments if necessary. The aim of the audit is to ensure compliance with transfer pricing regulations and protect the tax base. In a situation where the related party transactions do not comply with the arm's length principle, the TP regulations empower the tax authority to make necessary adjustments to the arm's length price, and this may result in additional tax liability to the affected taxpayer. Over the years, the focus of transfer pricing audit has evolved. Initially, the emphasis was on ensuring that all paperwork was correctly completed and submitted. The audits primarily involved checking if companies had all the necessary documentation in place and if it complied with regulatory requirements. However, now transfer pricing audits also scrutinize the actual content and economic reality of the transactions between related parties. This means auditors are not just looking at whether the right forms and documents are present, but they are also examining whether the transactions themselves are conducted at arm's length. In anticipation of audits, tax consultants must meet with the appropriate company officials to determine the appropriate transfer pricing methods to use in establishing the company's transfer prices. This discussion should clarify who is responsible for implementing any changes and gathering necessary information, and consider the potential financial results of the chosen method and the information needed to support these prices effectively. Consultants should perform periodic spot checks to ensure that transfer pricing is proceeding according to plan, as new employees or business problems may have created changes that the transfer pricing method does not reflect. It is important for consultants to understand audit triggers and effectively advise their clients on how to minimize the probability of a transfer pricing audit and its related burdens. Transfer pricing analysis is a costly but necessary process due to the increased importance of documenting transfer prices accurately. Therefore, understanding the extensive preparation of Federal Inland Revenue Service officials enables companies to better prepare for an appropriate response. Proper documentation is critical for 5 major reasons as follows: to ensure legal compliance, legal requirements govern the documentation of appropriate transfer prices; to avoid penalties, higher transfer pricing penalties may apply if companies lack proper documentation; burden of proof, companies generally bear the burden of proof for their tax positions; commercial efficiency, following best management practices assures the efficient use of resources; operational continuity, documentation helps to reduce retraining costs upon the inevitable departure of critical people within the company. Proper documentation also requires companies to make precautions in drafting the transfer pricing documents to protect the confidentiality of their trade secrets and commercially sensitive data. Contemporaneous documentation by multinational companies is critical throughout the transfer pricing process to ensure that the FIRS can effectively audit companies. Consequences of inadequate documentation. Failure to conduct appropriate analysis or to document transfer pricing policies can result in significant transfer pricing adjustments and related penalties. A transfer pricing inquiry is usually complicated and can become a costly exercise both for FRS and the taxpayer, so it should not be taken lightly. Due consideration should be given to the possible complexities and to the amount of tax at risk. Outcomes of effective audits. The outcome of an effective audit process has two aspects: increased future compliance. This indirectly contributes to future tax revenue and protection of the tax base. Increased current tax revenue. Successful audits result in increased tax revenue, which may refer to revenues collected in a year or two. The hard work involved in a transfer pricing audit may result in significant revenue adjustments that can be used for development of a country. However, due to the complexity and uncertainty inherent in transfer pricing issues, such results do not come quickly and easily. Transfer pricing units in both the tax administration and the private sector often come under significant scrutiny, as the returns from the resources devoted to developing transfer pricing capability tend not to be quickly achieved and are not always easily identifiable. Planning for a transfer pricing examination. Where the transfer pricing unit of the tax administration decides to examine transfer pricing, the examination team should ideally be comprised of overall manager who oversees multiple audits, team leader who manages day-to-day examination of a taxpayer, domestic examiner who handles audit activities related to domestic issues, international examiner who handles audit activities related to international issues, transfer pricing economist who provide economic analysis and support, lawyer who consult on legal aspects and may be involved in planning and implementation, computer audit specialist who assist with software needed to analyze data and organize it for examiners and economists. These roles may not always be filled in every team and can be combined or adjusted based on the audit needs. Preliminary examination. Before starting a transfer pricing audit, a desk audit of key transfer pricing information, which is already with the Federal Inland Revenue Service, should be conducted to identify potential transfer pricing issues. The findings from the desk audits guide further action that may need to be taken. Comparing the taxpayer's financial ratios to applicable standard industry ratios is useful if standard industry ratios can be found. Substantial deviations from standard industry ratios may indicate a transfer pricing problem. Understanding the taxpayer's business operation is an essential part of the transfer pricing examination. This study can be commenced before starting a transfer pricing audit or even after that time, and should include an understanding of the following: taxpayer's operations, the operations of its affiliates domestic and foreign, the relationship between the taxpayers and its affiliates domestic and foreign, the role each entity plays in carrying out the activities of the controlled group, and how much control and direction the taxpayer receives from the headquarters of the group. Audit procedure. A transfer pricing audit requires the examiner to schedule an initial appointment with the taxpayer either by phone or through a letter of notification. The examiners need to establish the transfer pricing examination plan, which may be divided into two parts. The first part identifies the audit team, the information they expect to obtain, and the timetable for the examination. This part can be disclosed to the taxpayer under its investigation. The second part identifies the tax administration resources to be devoted to the examination, the accounts and transfer pricing issues under examination, the anticipated procedures for the examination of each issue, the personnel responsible for the various steps, and the management procedure to be followed by the audit team. The information in part 2 is generally not disclosed to the taxpayer. In conclusion, understanding audit triggers, maintaining robust documentation, and implementing best practices are critical to ensuring compliance and minimizing potential tax liabilities. As global transfer pricing concerns grow, it's essential for companies to stay proactive, seek expert advice, and consider entering into advanced pricing agreements to mitigate risk. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.